We begin with the 6th chapter of the course. In this chapter, we will analyze one of the most developed financial instruments in the last years, the ETFs. An ETF, which stands for Exchange Traded Fund, is a security that replicates the movement of a basket of assets. Although ETFs can replicate any asset, generally they track the performance of an index. Like any traditional fund, an ETF is an investment vehicle that uses a pool of assets and is managed by professional investors, that is, by the portfolio manager, who invests the fund's capital according to the objective to replicate by the ETF. One of the biggest advantages of an ETF is that it trades on an exchange like any common stock. Let's consider the following figure to understand the concept of what an ETF is. On the left, we can see a representation of the S&P 500 index. Remember that the S&P 500 measures the stock price movement of the 500 largest companies in the U.S. Some of these companies are Tiffany, Microsoft, Coca-Cola, Bank of America, and Adobe. If we would like to replicate on our own the S&P 500 index, what we should do is to buy the 500 stocks that includes the index in the same proportion that the index ponders each of them. Therefore, we should pay a lot of commissions to the broker according to the number of transactions we would have to make. Also, our portfolio would be very hard to manage. This problem is solved by using ETFs. As previously said, an ETF is a fund that generally tracks the performance of an index. For example, the ETF called SPY tracks the performance of the S&P 500 index. As ETFs are traded on an exchange like any common stock, a single share of the SPY represents the performance of the S&P 500 index. Thus, if we would like to invest in the index, we could do it in a much more practical way. This is the biggest advantage of ETFs. Like any stock, each ETF has also a name and a symbol. The company that manages the fund is indicated in the ETF's name. Some of the most well-known companies that manage ETFs are SPDR, PowerShares, iShares, and ProShares. For example, one of the most popular ETFs is the SPDR S&P 500, whose symbol is SPY, and its objective is to replicate the S&P 500 index. Investing in ETFs has the following advantages. First, diversification. When we buy an ETF that tracks various assets, we are diversified in a very simple way and at a low cost. Another advantage is the trading strategies. With ETFs, we can use the same trading strategies used with stocks. That is, we can use limit and stop orders, or we can even sell short an ETF. Another great advantage is the wide variety of options we have. Although the first ETFs were designed to track the most well-known indexes, today there are a wide variety with respect to the tracked assets, from specific market sectors to commodities and currencies. They can even track assets on a leveraged or inverse way. Currently, ETFs can track indexes and assets of the following sectors: markets and sectors of the United States, markets and sectors of other countries and regions, commodities, and currencies. Let's see some of the ETFs that track markets and sectors of the United States. We have the ETF whose symbol is DIA and whose objective is to replicate the Dow Jones Industrial Average Index. As previously seen, we have the ETF whose symbol is SPY, which is one of the most well-known ETFs, and whose objective is to replicate the S&P 500 index. On the left, in the first column, we can see the name of each ETF. Here we are only mentioning the symbols. We have the ETF whose symbol is QQQ and whose objective is to replicate the NASDAQ 100 index. We have the ETF whose symbol is IWM and whose objective is to replicate the Russell 2000 index. The Russell 2000 is the index that represents the small cap stocks in the U.S. We have the ETF whose symbol is SSO and whose objective is to replicate twice the S&P 500 index. That is, it replicates 2 times the S&P 500 index. We have the ETF whose symbol is SH and whose objective is to replicate the inverse of the S&P 500 index. That is, it replicates the S&P 500 index multiplied by -1. And finally, we have the ETF whose symbol is SDS and whose objective is to replicate twice the inverse of the S&P 500 index. That is, it replicates the S&P 500 index multiplied by -2. ETFs that track indexes are known as index ETFs. On the other hand, ETFs that track an asset inversely are called inverse ETFs. And ETFs that amplify an asset performance are called leveraged ETFs. So let's see here some examples of inverse and leveraged ETFs. We had said that the SSO ETF replicates twice the S&P 500 index. The SH ETF replicates the inverse of the S&P 500 index. And the SDS ETF replicates twice the inverse of the S&P 500 index. So, if the S&P 500 index rises 1.5%, the SSO ETF will rise 3% because it replicates twice the index. The SH ETF will fall 1.5% because it replicates the inverse of the index. And the SDS ETF will fall 3% because it replicates twice the inverse of the index. In contrast, if the S&P 500 index falls 1%, the SSO ETF will fall 2% because it replicates twice the index. The SH ETF will rise 1% because it replicates the inverse of the index. And the SDS ETF will rise 2% because it replicates twice the inverse of the index. So, as ETFs can track assets on a leveraged or inverse way, we have a wide variety of options where to invest. Now, we continue with other ETFs of markets and sectors of the United States. We have the ETF whose symbol is IYR, and whose objective is to replicate the performance of the U.S. real estate sector. We have the ETF whose symbol is URE, and whose objective is to replicate twice the performance of the real estate sector. We have the ETF whose symbol is REK, and whose objective is to replicate the inverse of the performance of the real estate sector. We have the ETF whose symbol is SRS, and whose objective is to replicate twice the inverse of the performance of the real estate sector. We have the ETF whose symbol is XLF, and whose objective is to replicate the performance of the American financial sector. It tracks the IXM index, which represents U.S. banks and brokers. We have the ETF whose symbol is UYG, and whose objective is to replicate twice the performance of the financial sector. We have the ETF whose symbol is SEF, and whose objective is to replicate the inverse of the performance of the financial sector. And finally, we have the ETF whose symbol is SKF, and whose objective is to replicate twice the inverse of the performance of the financial sector. The first 4 ETFs we have just seen correspond to the real estate sector of the United States, and the last 4 correspond to the American financial sector. Now we continue with other ETFs of markets and sectors of the United States. We have the ETF whose symbol is SHY, and whose objective is to replicate the performance of the short-term U.S. Treasury bonds. We have the ETF whose symbol is TLT, and whose objective is to replicate the performance of the long-term U.S. Treasury bonds. We have the ETF whose symbol is TBT, and whose objective is to replicate twice the inverse of the performance of the long-term U.S. Treasury bonds. We have the ETF whose symbol is TIP, and whose objective is to replicate the performance of the inflation-protected U.S. Treasury bonds. We have the ETF whose symbol is LQD, and whose objective is to replicate the performance of the corporate bonds. We have the ETF whose symbol is DLN, and whose objective is to replicate the performance of the large capitalization segment of the U.S. dividend-paying market. And finally, we have the ETF whose symbol is FPX, and whose objective is to replicate the performance of the IPOX 100 index, which is an index of IPOs of several companies. The first 5 ETFs we have just mentioned correspond to U.S. bonds. The last one in particular corresponds to corporate bonds. The ETF whose symbol is DLN corresponds to the ones called dividends ETFs. It is important to mention that when the ETF invests in dividend-paying assets, these dividends are distributed among the shareholders in the same way as it is done for any common stock. And finally, we saw an example of an ETF of IPOs. As we have seen so far, ETFs really offer us a very varied menu in terms of investment opportunities.